Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyers Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello, everyone. Welcome back to a brand new episode of the Smart Property Investment Show. Grace Ormsby here. Super excited coming to you with a brand new update around the property space. As always, super busy time for the industry. There's never a dull moment really, but we've seen in recent days the RBA lift interest rates by another 0.5% to 1.35%. That's a pretty big jump, and it's against the backdrop of worsening affordability. We've seen prices move around a little bit since then because of that. And I'm sure many investors who are watching the space, looking online at some of the portals, have probably seen that already taking place. And it is a different aspect, I guess, depending on where you are in Australia too. And recently I sat down with LJ Hooker's head of research, Matthew Tiller, to talk through some of this. And I really hope you enjoy listening to this interview. Matthew, thank you so much for your time.
Thanks for having me, Grace. Great to be here.
Is it, from your perspective as well, has it been a pretty crazy period in real estate?
I think it's always crazy in real estate. There's always something going on in the market. But yeah, definitely since the beginning of 2020, there's been a lot change in a lot of the way we do business, a lot of the way, consumers, interact with agents and the real estate market's changed as well. So yeah, there's always something going on, but it's been particularly crazy over the past, 18 months to 2 years, definitely.
You've been in this space a while now, Matt. Where do you see, from your perspective, you'd be looking at data all the time, keeping an eye on what the markets are doing. Where are we actually at this point? Just to timestamp it for everyone listening, it is the 7th of July, financial year 2023. We're talking about right now. What are you seeing?
Yeah, it's always the biggest question I get is sort of what's the market doing and where's it going? But I really think that to really understand where we are in the market at the moment, what's coming next, we sort of need to take a step back and just have a look back at where we've come from. What's the market been doing? And I always find that the best way to do this is to look at the property market cycle. And I think that a lot of people within our industry and outside our industry, consumers, included, sort of forget that the property market moves through a cycle like any other market or like any other asset class or industry. So if we look at where we are in the cycle and where we've been, we can sort of forecast where we're moving to. So if there's one thing I suppose that I want to get across today to everyone is to have a look at the cycle. And I'll talk from a national perspective, but there's always cycles within cycles. So there's the national market cycle. We have a look at, each state has their own cycle. And then we drill down a little bit further. Each region, each suburb are unique within themselves. And every market moves at a different pace as well. So I think that's one of the big things today. So if we sort of jump back and we look at where we were sort of maybe leading into 2020, remember that the market was actually quite good. We'd come through 2018, there was the Royal Commission into banking, there was an election, and there was a little bit of softness in the market. And then the RBA started to cut rates just before the pandemic. Midway through 2019, is when the RBA started to cut its rates. And APRA as well, they had some kind of restrictions in there as well from the previous cycle. They started to ease that as well. So we sort of started 2020 quite good. The market was actually ramping up and it was going to be a great year in 2020. until, March came along. And so we're moving up into the peak of the cycle. March came along, and that's when obviously the pandemic was declared. And everyone thought then, that the market was going to go down, was going to tank. There was forecasts of, 20 to 40% price declines, and the market was going to go through, a downturn. It did, obviously, slightly, but the government stepped in, put all the stimulus measures in place. Unemployment peaked at 7%, but quickly dropped down as, things opened up again. And the government really supported businesses through that time, which really helped. And as the RBA dropped rates further, we moved through the cycle, the bottom of that cycle very quickly at the beginning of 2020, and the market turned to an upswing. And that upswing was really driven by people being secure within their jobs because unemployment was low, like I said, because of JobKeeper and other measures, and interest rates were low. So two factors were driving the market then. So this led to the upswing that we saw, which peaked at about in early 2021, around about March of 2021. So that was the top of the market. And people forget, I think, that the top of the market was actually a long time ago.
That's true.
Yeah. And so since then, prices have still been growing, but at a slower rate. And so as we've moved through the past 12 months, that growth rate has declined. A little bit of heat came out of the market because affordability got so low, I suppose, with all the price growth. And we came to the point where we're at the moment. So that is where other things like inflation, cost of living, what's happening overseas, with geopolitical kind of issues and conflicts came into effect. Inflation is rising. And so, the RBA has stepped in to curb that, just like other central banks around the world. And interest rates have started to rise, which in turn has sort of impacted property markets, but property markets were already slowing. So in terms of the cycle, we're moving through that down phase. So if we think March 2021 was, 12 o'clock on the clock, and if we think 6 o'clock is the bottom of the market, we're probably moving somewhere at around about 3 o'clock at the moment. So we're sort of halfway through the downturn. There's still more to come. There's still a bit more softness in the market. We've still got more rate rises to come. But that's where we are at in the point of the cycle at the moment, I think.
It's a really good way to visualize it, Matt, with that clock. And what you're saying really is that all of this is normal. And I think that's what we need to be remembering here, that none of this is, out of the ordinary. If we had seen those price drops at the beginning of March 2020, then yes, that would have been something that was unexpected and out of the ordinary. But so far, it just seems to be tracking quite normally. We've just seen it's been quite quick.
Yeah, absolutely. And I suppose, that upturn from March 2020, obviously that's when the pandemic was called, and the bottom of the market, it fell very quickly to the bottom of the market. It's been 12 months. That was a 12-month cycle between the bottom of the market and the top of the market in 2021. And it's slowly, gradually come off a lot slower since then. So, and I think the other thing we need to remember is 2021 was a massive year for real estate. It was a record year in terms of the number of transactions that occurred in the market. We had really strong buyer demand across not just capital city markets, but, it was a regionally led property market upturn. Transactions were happening all over the country, all markets, whether they're capital city or regional markets, were all, really strong. And I think we forget when we look at the numbers now and we say, well, we're down 5-10% from last year. We forget that last year was a record year. And so while, prices have come off in Sydney and Melbourne in particular, there's still some growth happening across other capital city markets. They haven't come off as much as those two our largest property markets. But the sales volumes, they're still holding up, not to the extent we saw last year, but the number of transactions, looking at, LJ Hooker numbers, when we compare it back to last year, we are down, by about 5% from last year. But over our 5-year average, we're still up about 20%. And looking back to 2019, we're still up about 40% on what happened before, the pandemic hit. So, we have to remember that 2021 was an anomaly. It was a really good year to be in real estate.
There's so much more to unpack here, but we're going to take a quick break first. See you on the other side.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back to this episode of Secrets of the Top 100 Agents. We're joined by LJ Hooker Group's Head of Research, Matthew Tiller. Matt, just before the break, you were talking about that property cycle. It's all been quite a normal cycle. While there was that anomaly of 2021 being an absolutely insane year, just in terms of numbers, it still is trending how we would expect a market cycle to look. I think what follows on from that, my next question is around, usually we see market cycles going from anywhere from 7 to 10 years. That's kind of just sort of an average. There are going to obviously be variations on there. This has happened quite a lot quicker than that. Do you think this is what we should be expecting into the future? We're obviously crystal ball gazing here, and it does depend on what's going on in the wider economic landscape. We can't control everything. COVID-19 definitely taught us that. Would you expect, though, just at the rate of change and the rate of pace and the way technology and people are changing their attitudes towards all sorts of things, will we see that reflected in the property markets of the future?
Yeah, of course. I think, we're in a shifting market, and I think just the way that the last upcycle played out, like I said before the ad, regional markets really led this cycle, and that's an anomaly in itself. The movement of people around the country relocating from capital cities to regional markets, from Victoria up to Queensland, looking for lifestyle, looking to be able to work from home differently. I think all that really does not just change the shape of the buyers within a certain market, but also changes the market cycle itself, because relocating from one area to another, it generally will mean more listings in one area and more buyers in another. So it just shifts the dynamic of cycles, not just at a national level, but in local and regional areas as well. I think also one way to understand where we are in the cycle as well and the shift in the cycle is also what we read in, and no offense to you, Grace, but what we read in the media as well. And
of course.
What the media are commentating on, because generally when we're in an upcycle, a strong upcycle, the media is always media commentary about getting APRA or the RBA to step in and tighten it up and, reduce prices and bring in affordability back into the market. And just as we're seeing now, when we're in a down cycle, it's all about the forecast from the banks and the economists, and the doomsday is about, 10, 20, 30% price drops over the next, 12 months. So that's where we're in the cycle at the moment. So we know we're in a down cycle because everyone's talking about how far prices are going to fall. But I think sort of crystal balling, like you say, I think what we've seen in the past is that APRA, the RBA and the government are all looking out for the property market. We know that, the government have some stimulus measures in place in terms of shared equity guarantees. State governments have their first home buyers grants still in place, and stamp duty concessions and those kind of things. And we know that when the market sort of falls, and there needs to be a bit of stimulus in the overall economy, governments will step in and provide stimulus to the property market because they know that helps the economy overall. So I think when we're talking about what we're thinking is going to happen moving forward, I think that sort of places a floor under any real sort of price crash. So I think, yes, prices will soften, but there will come a point where affordability becomes better and property becomes more affordable, that we see buyers jump back in the market and say, hey, there's some good deals out there, let's jump back in, because unemployment's low, that affects consumer sentiment and household sentiment. Yes, it's taken a hit at the moment because of the cost of living pressures and the inflation issue that we're having at the moment. So that's affecting, obviously, household budgets. There's also, the increases in interest rates, that's also affecting, obviously, household budgets. So we're going to see a sort of a softer buyer environment and moving forward over the short term. But that will correct itself as prices sort of soften, as inflation gets under control, because we still have a very strong employment market. People can still afford to pay their mortgage. So we're not really going to see too many distressed assets unless someone or buyers have really stretched themselves over the past 12 months.
Yeah, you make some really interesting points there, Matt. And I want to come back to the consumer sentiment part in just a little while. But to give it some context for this latest rate rise from the RBA, that 0.5%, we're now sitting at 1.35%, which is a reasonable way away from the 0.1% lows that we were seeing for much of 2021. How much impact do you think we'll directly see on the property market from this shift? Because there's a lot of conflicting information out there. We're hearing from a lot of people that, those lending ceilings that have been put in place and those buffers that have been implemented by APRA over the last couple of years should ensure that a lot of people still are able to afford their mortgages even at a higher rate. On the other hand, we're seeing, just how much money it's actually going to cost people extra to be forking out in their mortgage, and they haven't had those higher expenses for a long time. So it could come as a shock to those people as well. Where do you see it is it somewhere in the middle there that impact will be felt?
Yeah, definitely. And like I said, the combination of inflation and higher interest rates, that is going to affect buyer demand. It affects household budgets, whether you're a buyer, whether you're a renter. It doesn't matter where you are in terms of the housing market. It's affecting everyone at the moment. The reason, the RBA is increasing interest rates is to get inflation under control, is to help with those cost of living pressures. So once that's done, and we won't know whether the effect of the recent rate rises till the second half of this year, until we see those inflation numbers come out. And once that inflation is under control, once households are comfortable with their budgets, I think that's when we will see a return of buyers back into the market. But also, we have to remember that employment plays a big part in the market. And just because prices are going down doesn't mean we're going to see vendors just list their property for less than what they purchased it for. Rather than them listing, what they will do, vendors will just retreat from the market. And we've seen that already, especially within the auction markets. Rather than take a price that they don't want to take, they're just withdrawing from the market. So I think what we'll see is just stock being reduced from the market. We're already seeing that, like I said, in the auction markets. And vendors will just sit on their hands, pay their mortgage, the higher mortgage rates. Because they're in employment, they can afford it. And they'll just sit on their hands until a little bit down this cycle, maybe this time next year, until buyers come back in the market. They see that competition building between buyers and prices start to rise again. And then we'll see vendors jump back in the market and start listing again. So I think that while prices will soften, I think that, again, employment is good, and that will put a floor under the size of those price declines.
And it's also probably worth noting there that while we have seen huge gains just over the past 2 years, anyone who hadn't transacted during that time is probably still better off if they do end up selling over the next 12 months or so than they would have been, pre-2020. And that's probably what's going to just keep that market ticking along as it is for now.
Yeah, absolutely. And I think we have to remember what happened last year, 25 to 30%, 40% growth in some of those smaller markets over the course of a 12-month period.
It's unheard of.
It was crazy, yeah. So, even if prices fall 10 to 15%, we're still going to be back to where we were sort of, early 2021, that kind of level. So, and some markets will still be ahead. And some markets are still yet to see prices decline. We know Adelaide, Perth, they're having really tight supply of property at the moment. They still have some buyer demand in the market, and prices prices are still holding up. Queensland has seen that population growth, like I talked about before. They've seen people relocate there. They've seen buyer demand being quite strong. That's eased off a little bit, but not to the extent that supply has outpaced that demand. So there's still some strength in the Queensland market. So, and regional New South Wales as well. So there is still pockets there that aren't fitting this cycle of that we're talking about from a national perspective. So I think one of the things we need to really do, and my advice for agents out there, is to really understand the market cycle that you work in. Where's the national cycle? Where's the state cycle? And where's the local cycle? Because it can be conflicting at the moment, and we might be reading media reports about what's happening nationally or at a capital city level, but local markets move, in their own cycles, and the strength of their local economies really depend on where those markets are sitting at a local level.
There's definitely something to be said for agents who are able to, take what we're talking about here, implement, understand what's going on in their local markets and actually talk to consumers, potential vendors, potential buyers about what it actually means, because this doesn't actually sound like bad news for any party really out there. Affordability is going to improve. Yes, no one's going to see the capital gains that they saw over the last 18 months, but the floor is not going to drop out from under us. And that's good news for any party that's working on a property transaction over the next few months even.
Yeah, I mean, obviously that we have had that buyer competition that we saw over the past 12 to 18 months. I mean, it's going to be the hardest thing to convince vendors to list at the moment because of, all the media reports around the falling market about, rising mortgage rates, and that's what they're going to be focused on. So I think that's the biggest message, which is going to be hardest to overcome. But I think, looking at the data, looking at that cycle and just understanding where the local market is within a cycle can help tell that story.
It also sounds like really sage advice from an investor point of view. They should be aware of what these market cycles are doing in the areas that they're looking to purchase in and all of that. And is it a good time for these kind of people to be going out there and taking advantage of current market conditions?
Yeah, I think from an investment point of view, I think the rental market is in a different cycle to that of the sales market at the moment. So we're obviously seeing vacancy rates at extremely low levels right across the country. Rents are rising very quickly and prices are coming off. So really from an investment point of view, the yields out there are improving. So I think we're going to see, investors take advantage of that. Obviously, again, they will need to, reassess their budgets and have a look at mortgage rates and how that factors into the equation. But from an investment yield perspective, they will be improving over the course of this year. And, that's the segment of the market that I think will be active over the next 12 months.
I bring it up as well, Matt, because of all the talk around the rental crisis that we're seeing at the moment. But we're going to take a quick break before we jump into that. See you on the other side.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back to this episode. We're chatting with Matthew Tiller, LJ Hooker Group's Head of Research. Matt, it's been a really enlightening chat from my perspective so far, because while I feel like I did know some of this stuff, the way you've explained it has made a lot of sense and made it much more easy to apply to, what's going on in the markets, what we're actually seeing. And you brought up some points at the end about investors and why you think they'll stay relevant in the next 6 to 12 months in the market. And I think this is where the rental crisis probably rears its head. We've been hearing a lot about that and what that actually means moving forward. A lack of supply will be pushing up that demand. Even, investors who are forced to pay more on their mortgages, pushing up rents in areas where there's already very low rental vacancy rates. What are your thoughts on this? What are you seeing from some of the numbers you're crunching about how big of an issue this actually is, or is it being overblown?
No, I definitely think there is a bit of a rental crisis, in this country. I think it stems from, again, let's go back and have a look at how we got here. Back in the early parts of the pandemic there in early 2020, we saw no one was able to travel. And so a lot of the investors actually hold investment property in locations where we holiday, all those lifestyle locations up and down the coast, inland, in some of those iconic and idyllic lifestyle settings that we love to holiday at. No one could travel there. There was no domestic tourism. And so what happened was, first of all, rents fell in those markets, vacancies rose. And in some of those markets, investors just decided to sell their stock or place, short-term rentals into the long-term permanent rental market. So the start of the lack of supply sort of happened back then. And that's where, again, the cycle started. That's the bottom of this current cycle. And then as we slowly moved through last year, investors slowly gained a bit more momentum as tenants came back and, some tenants sort of moved back home. Some that were in share houses saw that rents had declined and they could afford their own place. So this sort of tenant demand sort of started to build. And as that built, investor demand built as well. But affordability, obviously from a price point of view, a sale point of view, was a factor. And also that sort of inhibited, the rental yields that investors could achieve on those properties because rents were, still soft at that time. But as rents have built, that supply has stayed low because investors haven't jumped back into the market to restock the rental market. And then again, as domestic tourism began to pick up, investors decided to look at those short-term gains on the short-term rental market as well. And that's where, some of that stock went. So capital cities in particular, we saw stock vacancy rates decline, and that really in turn drove rental growth. And, we're seeing pent-up tenant demand. We're seeing very low vacancy rates. We're seeing rents increase, and that's where we're at the moment. We're still not seeing enough supply, enough stock of, rental accommodation coming onto the market.
Okay. But as that clock, we'll come back to that clock that we were talking about earlier in the episode, moves down to 6, we should see that dynamic start to shift a bit, shouldn't we?
Yeah, absolutely. I think as the investment yields or the rental yields improve, as prices come off, sales prices come off, and rents continue to grow, like I said, investors will look at that and see the opportunity there in some of these markets that, are really great rental markets. They're great rental markets in terms of the amenity and the services and the restaurants, the entertainment and all that kind of stuff that tenants love to be around. There's some of those markets are going to present really great opportunities for investors. And they're going to be really positive from a numbers point of view, an investment point of view, because, rents are growing and prices are falling and there's tenant demand and vacancies are low. So, it's all shaping up to, in some of these pockets, are shaping up to really be some great investment opportunities out there.
It sounds like no matter whether you're an agent, a buyer, a seller, an investor, owner-occupier, there is a lot to love about, where the property market is heading, because I think while a lot of people have benefited from some massive capital gains over the last couple of years, we did need some element of normalcy to come back into that market and to see that happening and to see it so positive as well, Matt. Thank you so much for that insight. I'd love to know how long you think it will actually be. There's probably a few people wondering, how long are we until we actually bottom out in this cycle? You said, that might be a 10 to 15% drop, but all the indicators will remain good, even if that's the case and it is a normal market cycle. How long can we expect this to be going on before we hit that 6 on the clock?
Yeah, look, I love to be positive, but being realistic, I mean, there is softness in the market. There's no sugarcoating that, prices are going to decline. There is a softness in from a buyer's point of view as well, but there's definitely opportunities out there, and some of the economic fundamentals are positive as well. There's others that aren't so positive. But so from my perspective, and I'm just going to go back to what the RBA said in its last statement on Tuesday, and they're expecting inflation to get back into that 2 to 3% range around about this time next year. So what we expect there is interest rates will continue to increase until we see some signs that the RBA has inflation under control. And once it gets back into that 2 to 3% range, then obviously that's where the RBA steps back and the cash rate stays, at that neutral setting where inflation is in between the 2 to 3% target range of the RBA. So they're expecting that about next year. So the bottom of the market is probably somewhere around that period. I think there's going to be a time for adjustment over the course of the next 6 to 12 months where obviously we're going to see mortgage rates continue to rise. That, again, is going to put pressure on those that do have a mortgage. And remember that in the property market, a third own a house with a mortgage, a property with a mortgage, a third own a house outright, and a third are renters. So really, when we're talking about mortgages, we're talking about a third of the market or a third of households out there. So I think we're talking about the next 12-month period of softness in buyer demand, adjusting to higher mortgage rates. But also at the same time, I still think it's going to be a low level of stock, a low number of listings on the market for sale, because vendors are going to read the headlines. They're going to have really just sit back and pay their mortgage down and cover that cost until they see that buyer competition begin to rise about mid next year.
There you have it. We've covered a lot of ground today, Matt. Thank you so much for your time. I really do appreciate it.
No problem at all, Grace. Thanks for having me. It's been great to chat with you today.
To everyone who has been listening along, we hope you have enjoyed this episode. Please like or review us on whatever platform that you do listen to the Smart Property Investment Show on. We always take into account your feedback. We want to make sure that we're giving you up-to-date information. If you have any questions, don't hesitate to reach out to us. You can do that at editor@smartpropertyinvestment.com.au. Subscribe to our website for all the latest property news if you haven't already, smartpropertyinvestment.com.au, and stay up to date with us on our social media, Facebook, Twitter, and LinkedIn. That's all we have time for in today's update. We hope you enjoyed it. Stay safe and well wherever you are. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.